Yeah, so just wait for to see who else will come in.
Yes, ma'am.
Wait to see who else will come in. But did you have a chance to look at the chapter?
No, unfortunately.
Just dealing with the credit, how people get credit appraisal.
Credit appraisal.
So you were able to sign up for the other course? Right.
Good evening.
Well, it's just two of you, just waiting to see if anybody else will. Ms. Price, did you get the, chapter 8 and 9 on the assignment?
Yes, ma'am, I got it.
You know if Mr. Price got it?
Yes, he got his also.
Trying to finish, 2 chapters tonight, so we'll only have 1 chapter on Thursday. So the other time, because you know, school goes, classes ends next week. I'm trying to finish, so y'all will be able to have more time to actually study. So I want the exam to be on the 28th, Monday, and it'll be at best. You just have to confirm it with Ms. Dean.
Miss Smith, it's gonna be from 6 to 9 on a Monday.
Well, you know, it's left up to how long you all take. Yeah, it'll be, what, is it a issue?
Afternoon.
It may be a little hard to join on to do the exam on Monday, and I think that's the first day of school for my kids.
Oh, I sure y'all don't want it next week, Saturday. Because, classes finish and, the Thursday should be the last day of class. They tell us results at the end of a certain time. Monday isn't good for you. Anybody, you and Mr. Price?
If it's in the evening, we probably should be able to make it.
This your last week.
It will be in the evening. No, you said on Monday. You said on the 28th, that's the first day of class for your
Yeah.
kids.
Yeah, that's their first day of school, but we'll just find somebody to keep them to come take the exam from 6 to 9.
Well, it's left up to y'all, you know, if you finish in time, you just leave.
Okay, but we get a review sheet like last time.
I'm thinking about it, y'all is of me reading too much. Y'all is of me reading and don't read too much. So I'm thinking whether I'm going to be nice this time. Surely ain't helping me. Anticipating.
Miss Smith, I didn't get a
Right?
review sheet for last time, you know.
What you mean you didn't get a review sheet? Who's this?
This DeVoe. You sent it to my email?
Oh, I must see it wanted. I want a.
What a time. Okay, thank you. Got it?
Wrong. I can look for it. Oh,
Yeah, I never got it. I thought that I never got it.
all righty. I will look. Miss Adderley, did you get your assignment on chapter 8 and 9?
Good day. Yes, ma'am.
Everybody there?
Yeah.
Just want to make sure. Mr. Vo, I'll have to look. Yeah.
Please, thank you.
Went to that role email. Not sure what we got
I-
to.
Oh, that's where it went?
Probably, that's
Oh.
probably wet right there. It probably went right there. Right, so, like I say, trying to finish chapter 11 today, so we can finish this week. So you still have time for the review. for the exam, which will be on the 28th. And that's 50% of your grade, which we talked about before. And then what comes into play is a certain percentage of the 20% for assignment. Yeah, so, and what I do add all the assignment up, do my calculation from that, see how much you got out of 20%. Then the midterm, I do the same thing, see how much you got out of the 30%. And then on the finals, it'll be the same thing, and then I put all the grades together to come with a final score, whether it's an A, it's a B, it's a C. Yeah. Okay. Anybody had the opportunity to read? Hola, nobody?
I started to read the first chapter.
No one else? No one else read? Hello? Anyone else read, had a chance to look at credit appraisal? Hello, y'all can't hear me out. Pardon me? I'm just trying to find out if anybody else had an opportunity to read chapter 10. Ms. DeVoe, you're able to hear me, right?
Yes, ma'am.
Okay. Hello? Can y'all hear me?
Yes, we can hear you.
Well, how come ain't nobody answering me? I'm asking if y'all not, and only one person said they had the opportunity to read. I'm asking if anybody else had the opportunity to read chapter 10. All right, chapter 10 talks about credit appraisal. As we know, when a customer is getting a loan, the first thing has to be done. You have to make sure that the customer qualifies before a loan is actually granted to the customer. So when we look at the introduction, it says lending encompasses not only the initial decision to lend, which comprises the main part of this chapter, but it also monitoring of the loans overdrafts during its lifetime towards eventually repayment of the loan. In chapter 11, we consider the typical security that the bank might take when lending. In chapter 12, we talk about what can go wrong, and usually what can go wrong is persons default in their loan. So chapter 12 will deal with non-performing, how loans get where they are, wish lists, talk about all of that. So, but for now, chapter 10 speaks to credit appraisal. In this chapter, we approach the subject of initial lending decisions through the lens of a mnemonic Campari derived from the seven factors, characters, ability, means, purpose, amount, repayment, and insurance. And ICE refers to the ability, refers to, refers, referring to interest, charges, and extras, and usually apprehend to compare. These mnemonic helps us to remember elements of good credit assessment. That is the key principle of the responsible lending. We then go on to describe the modern credit score, which we talked about before, credit score, but here they should show us how the credit scores work. So the lending cycle, unlike most products sold by manufacturers and retailers, the credit facility has a life cycle, which means that banks are unable to determine the profitability of an individual loan until it has been fully repaid. Although there are accounting methods that can be used to estimate annual profit, 2007, 2008 global financial crisis showed us only too clearly that these can be wiped out by subsequent losses on loans, asset previously through to be secured. As we know, with well, we can speak to us on the about COVID and Dorian. During COVID and Dorian, a lot of people lost their jobs. So a person who probably was paying their loan consistently have a good job, make a good salary, but as we know, the hotels let go, other companies let go, a lot of people lost in Dorian, so people mortgages become behind. So when the mortgage become behind, what happens? No payment. So that's the reason why they're saying the banks cannot really say, they could say, okay, for the first 2 years we made this, but they don't know what is going to happen in the following years because of, like they always say, natural disaster can create a whole shift in anything. So things happen and person's not able to make their payments. So bank who was saying, oh, this person got a loan for 30 years. Hey, this is what our profit margin should look like. Because you know, when you get a loan, the first thing comes out from your loan payment is interest, your principal. If you look at, you get a new loan and you look at your, ask them for an amortization schedule and you look at your interest and your principal, you see the majority of money, if your payments is like a $1,500 a month, or say an $1,100, $1,200 a month, at least 800 and something go into your interest, and then you're gonna see one little 300 and something go into your principal. So a lot of times that's what they would say to you, it's good when, if you have a lump sum, just to put it on the principal, because once you put it on the principal, it actually decreases your loan balance. So a lot of people don't opt to say, decrease my payment also. They say, leave my payment as is, and they continue to put money to their principal, so which allows their loan balance to be going down and the interest will be going down because more money is going to the principal. Much for the retail banker, the lending life cycle has a number of interlinked stages, as illustrated down in 10.1. Courtship, marketing, birth, loan agreement, life cycle, now rebirth, renewal, life cycle, death, because you know your dead, the loan. Well, not all, me dying, I don't have the debt anymore, but sometimes you have the other person who's on the loan, if the loan is joint, or even if the person die and the loan was not paid off and the children say, do a probate, go to probate with it, and they get it, they still have to pay the loan because the persons didn't have insurance. And like a lot of banks today don't even stipulate that persons have to have life insurance. So I know back in the days, you had to have it, but a lot of persons will say no, they didn't have to have a life insurance. I think that is so necessary, especially when you're getting a mortgage loan, because today is not promised, so tomorrow is worse. Much marketing and credit appraisal effort is extended in the courtship stage, at which managers seek new customers or to provide new products to existing customers. Birth occurs when a loan, overdraft, or other credit facility is granted. So we know if when we talk about birth, just like humans, so they have to actually go out there, bring in the new loans. So when they get in the new loans is considered birth. So it's maintaining them, hoping that the customers who you grant the loan to continue to pay their credit. A loan then has a life, which is expected to end at a certain period. So I got a mortgage for 30 years. So hey, I just started. And if I started now, add 30 onto that, how much more years I have to pay? So and usually we expect it to end successfully. We expect it to the repayment to happen the way it should on a monthly basis. But like we say, unforeseen situation, disasters, anything, people losing their jobs, somebody getting sick, somebody unable to work. So all of that contributes to us, a lot of people not being able to live up to their commitments, which even the banker may seek to lend again to a customer, which is rebirth. So we call it refinancing. A lot of people do refinancing. And I think after COVID and Dorian, a lot of people had to do refinancing because they fell behind, and some banks allow refinancing, a lot of banks didn't. And some people didn't want it. Some people say just sell the property. So yes, a lot of people do refinancing, and a lot of people, even when there's not an actual situation of disaster or some unforeseen situation, people do further charge, or they do further charge because they got a mortgage and they have a lot of equity in the property. So before they go to a bank to get a consumer loan, they just go to their bank and say, I have 3 more years to pay for this loan, this mortgage, and I want to do some renovations. My son is going to college, so they have a lot of equity in the actual mortgage in their home. So the bank would give them, and they call it rebirth. The bank will give them further charge, or just rewrite the loan. Some people do. Some people say, I just want a further charge. So that's what happens there. So, and they call that rebirth. Life could otherwise end with a loan facility being renegotiated or refinanced over a different term, or with a different repayment schedule, perhaps because the customer is encountering financial difficulties. Some loans, however, end in the debt. That is in the debt of in the debt that is the customer failed to repay, and may even go through a legal mechanism such as court actions and insolvency. We know that happened because, like you say, a lot of times you look in the newspaper, you see Bank of the Bahamas, a mortgage corporation, Scotia, a RBC, a FinCo, a Fidelity. You see them have in the newspaper where they have court order to sell somebody's house. So, like I say, unforeseen situations causes hardships, and persons end up where they are, not that's where they want to be. They were good paying customers, but situations happen and they were unable to meet their commitments. And a loan and in debt, the whole of the loan advance, along with the unrecovered monitoring costs and unpaid interest, may be lost to the bank. That is, the bank makes a loss on the loan, provided that the bank can make profit. Can make profit on its other loan asset. It can bear such loss where losses are too many or too great. However, the bank itself could fail. It is consequently essential that lessons learned from unpaid loans be fed back to those managers marketing and granting loans at the beginning of the lending cycle. Like we say with anything, in lending, be it consumer, be it mortgage loan, um, things happen. A person, like I said, could be a good paying customer, but something happened and so failed, the manager could have done their due diligence by doing everything right, but life situations happen and person's not able to meet their commitments. We come down and talk about the principles of lending. The principles or canons of lending are generic and applies to large corporations as well as to small businesses or personal borrowers. Credit scores criteria at which we will look later in the chapter can draw heavily on these facts. Historically, credit assessments or appraisals was often seen as act, a dark art practiced only by older, experienced bankers. So we see historically they saw appraisal was seen as a dark art, art, art practiced only by older, experienced bankers who would often offer little explanations for their decisions, such as opacity in not constructive, however, and it is possible to decide the elements that contributes to responsible lending decisions into key principles that will help a client to avoid the key risk when extending credit. Anyone, can you say it, I mean, they say it's a key risk, but do you feel that um, if a person does everything by the books, do you feel that something could still not go wrong?
Yes.
Because like, why do you feel so?
I mean, because it still all goes back to what you were saying with things happening in life that we don't plan. So everything could be good, or that applicant could be what we would call the perfect applicant, but something could happen at some point along the term of the loan that could cause the applicant to be, or the loan to go out of what we thought it would be.
Agreed. And like I say, we saw that if anything, as you read through the book, you see every time they bring up the 2007, 2008 crisis, financial crisis. So that alone took a toll on a lot of customers. A lot of customers lose homes, lose a lot of businesses because of the crisis. Um, where am I? This may seem a tall order, but we will see that this area draws on a number of other disciplines. It may be complex and to some degree uncertain, but it can equally be highly rewarding. As we saw in chapter 5 and 6, the bank regulators recognize certain risks as associated with granting credit. Yes, we saw the different type of risks. We have reputational risk, market risk, credit risk, legal risk, liquidity risk, interest risk. All of these risks we saw in chapter 5 and 6. Yeah. The most obvious of these risks of non-payment and subsequently loss, but poor lending decisions can also involve reputational risk, market risk, whereas a bank needs to spread its lending across different industries and market. Legal risk, especially where security is taken and the interest and the liquidity risk, especially for large non-syndicated loans. And so we know that legal risk is a part of it because if persons don't take, well, we take security and sometimes still, just like I say, we know now in the climate that we're in, um, salary deduction is a security, believe it or not. Salary deduction is a security. Back in the days, you had to have, it wasn't dependent on salary deduction like that, but now it's the norm that salary deduction be government paid as long as you can get a salary deduction. That's their collateral, that's their security. which I always disagreed with, but that is the norm. And that's why a lot of people, we spoke about earlier in the class, that a lot of people just opt to leave government, leave their big loans, and go to Canada or the US. And I guess they never coming back home, because I think a lot of times people don't understand that even though you may have a loan and you don't pay the loan become non-performing. A lot of times the bank have those loans still there because they call them charge off, active charge off. Because after 3 months, the bank won't be taking interest from a customer's account. After 3 months, everything automatically goes to the principal. And if the loan get refinanced or whatever, then they work it, reconstruct the loan all over and work all those years that the interest wasn't being paid back into the loan. So like I say, and a lot of people don't understand, they could go away, come back and try to go to that bank to get a loan. And the person pull it up and say, hey, you get one charge off loan here or active charge off loan sitting here. Can't get a loan right then. They need to, really tie them down and say, oh, you need to pay this loan off, So a lot of times people think they're getting away because they choose not to pay their loans and they've been gone for a while. So they feel, well, I don't have to worry, that loan get paid off. They have allocation for it. Like I say, they always make provisions for loans that they feel will go into non-performing. And that's why they have a wish list. From the first, second month, they know, hey, this person ain't pay. Hey, what's the chances that they don't become non-performing? So they're on a wish list right off the top. Yeah, these customers, I'm not too sure about them. Ms. DeVoe, can you read the key risks with which we are concerned? 118.
Yes, ma'am. The key risks which we are concerned in this chapter are as follows. Adverse selection. This risk refers to the fact that the most creditworthy customer do not need to borrow, and only those without current funds of their own request credit. Adverse selection is also highlighted by information astromatic. That is the situation in which the borrower has information that the bank does not, which could change the bank risk assessment if they were to be revealed. Moral hazard. This refers to the bank. This refers to the risk that a borrower may act in such a way that the level of risk changes after the loan has been granted. An extreme example is a borrower who wishes to start a business and successfully borrows from a bank to do so. Yet rather than invest in the business, the borrower gambles the money and loses everything, including the ability to repay the loan. The first,
One second, Mr. DeVoe. Okay, so we see situation like this happened before. Persons, I don't know, some of you all remember persons who, when the government first started that, that student loan thing, a lot of people got loans. A lot of persons got loans so their children going to college. Children never gone to college, or the children who actually went to college never actually came back and paid the loan. They used the money to buy a car, do whatever, before they actually put some kind of levy on that Bank of the Bahamas granting student loan, that people were getting loans for anything and nobody was actually falling. Oh, I go into college. Oh, you have all those papers. You have this, you have that. So I guess, and like they say too, people get the money to say they start in a business and they take the money and gamble it and lose all their money. So they lose the money, couldn't start the business. So they actually, they can't pay the loan because they probably have so much gambling debt. So there again, like I say, it's a two-edged sword where people come to get money for one purposes. And especially if I don't know now, but before, oh, just make a check payable to me, but I think, it's gotten more tightened now that if you say you want to buy a car and you're getting it, so they will actually make the check payable to the person who you're getting the car for. Miss Price, is that the case?
Can you repeat the question for me, please?
I want to know, like, when a customer comes and say, I want to get a loan, say, I want to buy some furniture, I want to buy a car, is the check made payable to the place that you're getting the furniture and the person and the lot, car lot where you're getting the car?
It depends on the amount. So if it's a large amount, it'll be made payable directly to the place where the money is going.
And so when you say according to your amount, what amount would you not make the check payable to the actual?
Anything over
Place.
20,000, so anything under 20, you wouldn't really need to make a check payable to the company.
Oh, so I could come and get a loan for under 20,000 and just say I just doing some stuff and y'all make check payable to me?
Yeah, the money would just be credited to your account.
Wow. Because I know some places now they're like, okay, you getting a car? Okay, the car dealer name. Okay, you buying some furniture? Okay. Robert's Furniture, multi-discount. Ready? Okay, thanks, Mr. Vo, continue.
The first of these risks is migrated, but not completely avoided, by gathering as much information as the borrower and the lender proposition as possible. The second can be migrated by using loan covenant or by taking security. Table 10.1. Gathering together some of the most common, help me out, numeric devices that can be used as a framework when gathering data to inform a lending proposition. It should be noted that in each set of criteria, the personality or character of the borrower ranks highly, while identification of the security on offer is considered only after the borrower's ability to repay has been reviewed. This is very much as it should be. Bad lending propositions do not get better simply because security is available. Rather, they should be judged on their merits and security sought only to provide for repayment in unforeseen circumstances.
1 second for me, Mr. Ho. Ms. Price, with what do y'all like? How they have here? You have the 4 C's, the 3 C's. What I know with the banks, y'all use the debt service ratio, and do y'all use anything else when qualifying a customer for a loan, be it a consumer or mortgage?
We do. The debt to service ratio is the most important, but the system also looks at like how long the customer's been working, how much money they earn. It basically looks at how stable they are. So the system will give them a score, but ultimately the debt to service ratio is the most important thing.
So when you work the debt service ratio, like, hey, we have a government customer who a government employee who you know that some government employees and other employees, you know, on their pay slip don't always say all their bills, because you're some persons who are government employees, their mortgage payment don't highlight on their pay slip. You ever had a situation where a customer had a mortgage, but it's not showing up on their pay slip, on their, pay slip showing their deductions?
Yeah, I did have that instance before, but now that we have the credit bureau, basically everything shows up on those reports. Only only Bahamas Mortgage Corp isn't on the credit bureau yet, I think.
Okay, so because I have a mortgage at Cinco, but it's not showing on my salary slip, because of the credit bureau now, you're still able to pick it up.
Yeah, the credit bureau will pick up anything you had from 2018.
Anything I had from 2018, so what happens to the one if I had it from 2009? Now you pick it up.
It will if it's still active, but if it was closed before 2018, it wouldn't show it.
So as long as it's still active, it will show up. Okay.
Yes, ma'am.
Our Miss DeVoe.
Common lending, nomadic. 3 C's, character, capability, capital. 4 C's, character, capability, capital, and connection. Campari. Character, ability, means, purpose, amount, repayment, and insurance. Chris. Character, repay, incentive, and security. ICE. Interest, charges, and extras usually added to Campari. IPART. Integrity, purpose, amount, repayment, terms, and security. Paris. Persons, amount, repayment, security, expenditure, remuneration, and service. One final point is worth emphasizing in relation to the criteria that to which these nomadic devices refer. While they present the criteria in a particular order, different types of lending propositions have different priorities, and so the weight that the lending attributes to each of the factors and the order in which the lender consider them will vary depending on the specific circumstances. A lender deciding whether or not to grant a closed bridging loan, for example, whereby funds are guaranteed to be delivered by a solicitor, which is secured or an existing property, will be little concerned with the borrower's character. Whether or not to extend an overdraft, however, will depend heavily on the customer's past record with the bank and proven ability to manage such facility. In the following select section, we will consider in more detail 2 of the limits, Campari and ICE.
Thanks,
Campari.
Miss DeVoe.
Okay.
Thank
you.
Thanks. So here they're talking about Miss Price. I'm sorry that who else I'm needing? Yes, I don't see. Miss Adderley, where you work?
Commonwealth Bank.
Right, so I can ask you to. You work in loan?
No, ma'am. Operations.
Okay. Miss Price, sorry to ask, but you're alone, so I'm just gonna ask you some stuff. Bridging loans, do Scotia do bridging loans?
No, ma'am.
So y'all don't. What about overdraft facility, like loans against? I know some people will take an overdraft, like I talked about with equity in their property. You know, they have a lot of equity, so instead of just getting a consumer loan, they'll say, okay, I want an overdraft facility. Give me a further charge, which I can use and have my overdraft on my checking account for a certain dollar value, because I want to use the equity in my home, and you give me a further charge. So I'm trying to find out, do y'all do that also? Like people can get an equity loan and create an overdraft facility?
We do equity loans a lot, refinances and further charges, but overdraft, they only do overdrafts on the small business side, not on the personal side.
All right, now we have Campari. First, we consider the criteria that relates to the borrower and the lender proposition. Character. Now we know with anything, people will say your character, but we know too in anything is who you know. And if you're good, you have good, if you know people, you go to that bank, because you've been banking there. You have a couple dollars in the bank, so hey, yeah, that's right off the bat, you could get it. The borrower who seeks to be lent money entrusted to the bank by the depositors must be of the utmost integrity, somebody who will keep their word and who can be believed. In an ideal world, the lender would seek evidence to support the borrower's claim, but as often has to rely on the person's word and its own subjective assessment. Ms. Price, again, this talking about character, does that play a heavy role when you consider giving a loan? Other than just the debt service ratio?
I wouldn't say it plays a heavy role, but it does play a part of it.
Okay, because you could have a customer who comes and who could talk very good, but when you look at their records, you'd be like, oh, that's a good talker. But when I put the figures together and try to get the percentage, it doesn't match. So you look at that, but you don't rely, you still totally rely on the debt service ratio to qualify your customer, right?
Yes, that's correct.
Much turns on a borrower track record with the bank. In the case of a new borrower, the lender skilled and experienced in interviewing borrowers and the borrower credit history, see personal credit history, will be pivotal. Modern credit search will reveal not only past good and bad behavior in repaying loans and managing credit card debt, but also the extent of a person borrowing capacity. That is how many credit cards and loans they possess. The greater a person access to further borrowing, the higher their sensitivity to interest rate rises or changes in the personal circumstances. In the assessing business borrowers, annual accounts are often a source of detailed information about the historic trends. For that is the character of the business. Consideration relating to the company's account are beyond the scopes of this book. But it is worth noting here that accounts for small businesses are rarely prepared for banks. Rather, they are more commonly prepared with the goal of reducing tax liabilities. And as a consequence, a lender should be wary of hidden or deferred items and may impact on the company's ability to repay. Often banks will seek to corroborate key accounting data such as turnover, perhaps by means of the bank account, stocks, or even by making a site visit. Moreover, it is worth remembering that the lender ability to interview and subjectively assess the character and the professional ability of the company's directors will be no less critical in business lending decision than in a relations to personal lending. So as we know, Ms. Price again, when a customer, a commercial or business customer wants a loan, how many, is it a number of years or is it a couple of months that they have to have their bank statement showing all their ins and outs because they're self-employed or they have a business? How many months or how many years they have to present to the bank showing that, okay, this is what I got and this is what I paid out? How many years or how many months the person will have to present to the bank to get a loan, at least to be considered for a loan?
I never worked on the business side, but I believe it's 6 months minimum.
Okay, so once they have 6 months, they can show that, okay, I make $100,000 every month. And this is my expenses, and this is what I'm left with. 6 months. And that's the self-employed persons also. Ability. It is essential for a business whether or not loans are involved that its management has professional capacity, competency. The borrower must be at least proficient, if not an expert at their jobs or in their profession. Do you feel that happens? When it talks about ability, do you think a lot of persons have the management skills or they proficient in the actual business that they going into? Ms. Minus?
Hello, hi. Can you repeat the question again, please?
I was asking, whether you think persons are proficient in the businesses that they sometimes go into? Do you think they are proficient? Are they
Yeah.
expert in their business that they're going into? Do you think
You mean-
everybody who decides to go into a business, this is what they're saying about the ability? You know, I'm saying if you think most persons who go into businesses are expert and proficient in the line of business that they want to do, or they get in the loan for, do you think a lot of persons are proficient in it or expert in the job?
I don't think everybody is an expert. I believe they get help with certain areas of their business, but or they get some type of training or go do a course or anything depending on the business. But I don't think everyone is an expert.
A lender must seek out any signs of incompetency. If the customer has been with the bank for many years, there should be such clues in the bank database. But if the lending application is from somebody unknown to the bank, tactful but searching questions must be asked at the interview and evidence sorted by way of testimonial or qualifications. A baker who has had years of experience in working for a large bakery, for example, may wish to start up his own little small business. While there are technical credentials may be unquestioned, their ability to manage others and to run a business must be reviewed if the loan is to be granted. Right? Because I could be a baker, but me being a baker doesn't say I have management skills that I'm able to manage a couple of people. I may not be able to manage money, you know, because I'm working for someone, so I'm just a baker. And so I think, yes, that needs to be considered. And so that's why they always say, if you're the business owner, you shouldn't be doing the books. You shouldn't be dipping your hand in certain things. Hey, you do all the baking. You hire persons who could say, hey, do the accounting work, do the marketing work, you know, just other people than you who don't have the experience trying to actually run the business when you know you're a baker. And the one thing you know how to do is bake. A banker would be very interested to know that whether a borrower has the ability and the capacity required, the competency required to carry out the project for which the credit is required. This aspect is less important in consumer loans, but virtual in small business market because they run in the business, so they can't just be in the kitchen baking. They have to also have the expertise when it comes to finance, managing the money, managing staff. So a lot of people sometimes just think, oh, I could bake, so oh, I could open my own business. I could do everything, but no, that doesn't work. Miss Minus, can you continue for me, please? Means of margin, means or margin.
Yes, ma'am. Means or margin. How much of their own money is the borrower using and how much belongs to other people, including the bank and other lenders, such as hire purchase, HP, company or finance house. Family finance is also a source of further borrowing, and even this must be repaid at some time. These figures ought to be apparent from the loan application, and it is important to remember that many borrowers underestimate the amount that they need to borrow. A good rule of thumb is in business lending is that a bank ought to not to put in more money than the borrower. In so doing, the bank takes an equal risk on the success of the venture unless the loan is secured, but receives only interest on the borrowings rather than a share of profit. Moreover, customers often finance themselves partly by delayed payments for goods and service bought from their suppliers, but accepting only cash payments themselves. A review of the current liabilities of a balance sheet will give the banker clues here. A focus on the gearing or leverage of a business will also illustrate the business sensitivity in market changes, such as recession or interest rate increases. Purpose. The purpose of borrowing is extremely important. There are two main reasons why customers require loans or overdrafts: to acquire an asset or to anticipate income. When personal loans were launched in the UK in 1958, a loan for a holiday would have been rejected because the loan's purpose was unacceptable, not a necessity, but a luxury. Today, a 12-month loan for a holiday will often be agreed. Increasingly, banks concern themselves far more than the ability to repay rather than the purpose, especially for personal borrowers. In commercial lending, however, there is a more important reason why purpose is important. The purpose for which the loan is used will affect the finances of the borrowing firm, and projections for the next 2 or 3 years will vary according to the use to which the money is put. If a firm were to buy the freehold of its existing shop, you would expect to see no rent payments in the cash flow projections. Possibly a dramatic change, but if the money were instead used to buy stock, then we would see cash coming into the business from the sales of that stock, assuming the sale are for cash and not credit. It is, of course, also essential that the bank consider its reputational risk when deciding on the validity of purpose in a lending decision. It must ensure that the loan will not be used for illegal or nefarious purpose.
How would the bank know that sort of stuff? Especially now where we just did consumer loan. I saw the place name, Sunshine Finance. They lending up to 75,000. Oh, Miss Price, you say y'all is lending up to how much for consumer loans?
We land up to about 40,000.
Oh, y'all only lend 40. Oh, Miss Commonwealth, Adelaide, you know how much y'all is lend up to? I know you say you work in operations.
I'm not certain of the figure.
Well, I saw advertising 75. I know when I worked at, I used to be like, you have to be kidding. Someone is getting what they got a loan last year. They got 50,000. What do they do with that? Oh, nothing tangible. What do they do with that? Then they're back again. Oh, I want to buy a car. Oh, I want to go on a vacation. I'm like, when it's time for you to get a house, it's very difficult. That's why you find a lot of people unable to actually qualify because the purpose is luxury. It's not to say it's a need. People just borrow sometimes. I just won't get away. I'm going on vacation. Oh, I'm getting married. I'm doing this. So, or somebody dying, they're gonna borrow all that money and they still have to pay it back. I say, that's why you have some people who work for government, or even people who have government, who have salary deduction. If you see what they take home, you'd be like, how they make it? Because that money, what they borrow is already gone, because they keep, what they call it, talk up. They keep talking up the loan, talking up the loan. A lot of that, a lot of things people don't understand when you talk up. People don't know that you're still paying administration fees, you're still paying all these different fees. Ms. Price, as a officer or working in loans, when customers want to top up or customers want to refinance, do you tell them about these different fees that they paid like 6 months ago that they pay these same fees again? Maybe more. Do you tell your customers that?
Do I tell them about the fees that they have to pay?
Yeah, and you know, because they just paid that fee must be a year ago, and they back again won't get top up, or not even a year, 6 months. How often do y'all allow customers to get loans with your, like, to top up, like some banks call it top up?
They could get as much as they want as long as their salary can handle it and as long as they have the equity in their home.
Okay, what I mean, like, okay, say I've been there, like, you do consumer loans too, right?
Yes, I've done them before. I specifically deal with mortgages now, but I used to
When
deal
you,
with just ones.
when you did consumer loans, how often could a person come back for a top up? Say they got a top up in January, when would they be qualified to come back to get another top up?
They usually would be able to get a top up in about 6 months.
Okay, Ms. Minus, you could continue for me, please.
Okay. Amount. In many service environments, the mantra, the customer is always right, is oft repeated. In retail banking, this can be dangerous assumption because borrowers often have a need to borrow, but cannot calculate how much is needed. If the borrower asks for less than is needed in the hope of making the loan proposition, seems more attractive to the lender or because the calculation has been based on faulty cash flow forecasts, the risk is that the loan will be insufficient for purpose, and that will impact negatively on the borrower's ability to repay. Even if the loan sought as a mortgage, the borrower may have failed to take into account legal and professional fees. A business manager may have failed to take certain running costs into account when calculating the income that will be generated from which repayment will be made. The type of lending, that is loan or overdraft, will also impact on the amount required. An overdraft should turn over regularly. That is, the account should go in and out of credit, while a loan is typically fixed on at the outset.
Thank you.
Okay.
So now we look at repayment. Repayment is critical. And we know too, like a lot of times I know back in the days, a lot of times you have people who say, they want to get a loan, they're not able to qualify. So they have a little company who they know somebody there who could say, oh, he's worked for me. She's worked for me, or she's made $300. Besides me working for that government, working for government, I got this little job on the side making $300 a week. So when I come to the bank now, I won't get this loan coming under false pretense right off the top, because I had my friend who have this company to do a letter to say I work for him, making $300 a week. So now I come to the bank look at the letter, oh, this person been working here for a while, yada, yada. And now they qualify the person for, say, the person want to get a consumer loan or a mortgage loan. And what happened? He is not working on a part-time job. he only has that government salary. So what happens to that loan at the end of the day? Because he said he's taking he's having the loan officer take into consideration this $300 added on to his probably $2,500 that he making, which out of that 25, probably 1,000 of that is actually bills. But because he got this extra $300 a week, it outshadows that bill that he has. So as far as the loan officer is concerned, they using that to qualify for this amount. At the end of the day, what consumers and borrowers don't understand, at the end of the day, that loan was granted to you with saying that you had that extra $300. A lot of people don't even look at that. And that's why we find a lot of people at the end of the day end up losing their properties, losing their cars, losing stuff because they were they represent themselves falsely to the loan officer, and the person who actually give them the letter don't know that they're doing more harm than good, because you're not giving that person $300 a week. But that when the loan officer do their calculation, they're taking that into consideration. So what happens to you at the end of the day when your loan payment, they were giving you this loan payment because of the amount inclusive of your $300 a week. So that's the loan that they're granting you the loan, and the loan payment is consistent with what you have to pay, because it's the amount you could qualify for. But at the end of the day, you can't really qualify for that, because that is falsified that you earned this $300 a week. The critical question for lenders here is how the borrower intends to fund repayment. There are two main sources from income, for example, a firm sale, a personal borrower salary, or from the sale of an existing asset. For example, a home. In the case of bridging loans or the maturation of an endowment policy for someone seeking to fund a world cruise in their retirement. Whatever the repayment source, it must be known before the loan is granted, and it must be agreeable to both the lender and the borrower. Importantly, for responsible lending decision, repayment must not stretch the borrower too far. Ms. Price, you said your debt service ratio is 45 and can go up to what for a loan?
We could go up to 50%.
But you can go up to 50%. Do you ever go over that for some customers?
No, we don't ever go over that.
No, central bank give a leeway that sometimes officers or lenders go to their VP, and the VP say, okay, you send it in, they get they work it, the VP give them approval, and they say, okay, this person a good customer, but I know our debt service ratio say 50, but this person they 51. I've seen where VP of lending would say okay, and they would approve the loan, but they have to get approval from higher ups. Has the personal borrower demonstrated an ability to save the amount of the monthly repayment in the recent past? And that's what people don't understand, And that's I always say to students, persons who I encounter, savings is not that I can save $500 a month. It's your consistency, how you save. Hey, this person saved $300 every month for the past 10 years, $300 every month. So that person who's saving $300 every month compared to you who's saving $5 every month, but you're always dipping in it. Which person you think the bank is going to look at and recognize as a saver? Because that person was saving consistently. They show they have the ability to save. they weren't dipping in it. For 10 years, they saved $300 a month. And as I said, a lot of times people think I'm saving $500 or $600 a month and having to go back into it. That's not saving, you know. And as I say, just have an account. If you're not a person who can actually say, you know, I ain't going there, just put the account with no debit card at another bank where you know that bank so far, if you gotta go driving with, you ain't gonna do it. So, and that's a lot of people, if you can't save, that's some of the things that you have to do. Put the money where you can't get it. Has the personal borrower demonstrate the ability that they save in the past? How stable is the borrower employment and the salary? Yeah, because you could have somebody as a housekeeper, Mr. Paul pay me $600 a week, but what happens is Mr. Paul consistent in paying you that $600 every week, or you'd see $400 get deposited to your account, and the next week another two get deposited there, and then he continuously owes you and owes you and owes you. So here again, yes, you have to look at their employment and their salary. Are overtimes or irregular bonuses payments included in income figure quoted? Do y'all take into consideration, Ms. Price, overtime and bonuses when you're grant a loan?
Yeah, we take into consideration over time, but it has to be consistent and then we would discount it.
What about bonuses?
No, we don't use bonuses. We'll use housing allowances and different allowances, but not bonuses.
You'll use clothing allowances like those people in them government job.
Yeah, we'll use allowances. We also use gratuities.
Okay. In cases of business borrowers, does the cash flow forecast cater adequately for the regular repayment and interest? Have all likely costs been estimated and deducted? Are there written quotations for these, such as building work? Are the contract for sales of goods? A common error among new businesses that look profitable and liquid on paper is to forget such things as the owner's drawing or tax liabilities. And we know right now everything is going up. A lot of, I know I went into Go Postal and I asked the lady, I said, if I was to bring in a TV, 32-inch, what would you all charge to bring that in? The lady said 200 and something. She said, because nowadays the government is going up on all these different taxes, so they have to, you know, give it to the customer. Then I saw something on the news yesterday or read it in the papers, read it on BN, that day before, if you want to host a party or a concert or something, to get a license used to be $25. You know what it costs now, because they now actually taxing these people. It costs $750 now, from $25 to now $750. If you want to host events and stuff like that, you have to pay $750. So, like I say, inflation is up, the BPL, everything is going up. So we have to take in consideration, I guess, when getting a loan, we have to look at all these different areas: real property tax, house insurance, and if you got a mortgage at a bank, you have to take out that house insurance for that big amount, total comprehensive house insurance. You have to take it out. And so, like I say, the banks, sometimes you judge and you give people loans because of, you know, you look at their history, you look at their capability, and unforeseen things can happen, and What happens? Person default, loan become non-performing. Um, an experienced lender can tell whether the income and cost estimate are likely to hold true or common costs may have been omitted. Sometimes common sense can be the key here. Because like I think I talked about before I asked you, Ms. Price, um, customer can say, um, I want this loan to add an addition to my house. Okay, person got estimate from, say, their father, who because it's their father, he said, I'm giving them a break. So he gave them a price which is like probably 50,000 less than what the actual appraisal says. What would you do in that situation, Ms. Price? Because that's a father, do y'all take into consideration that he's given a break on it by his price against the actual appraisal price, what it would cost to complete the building or complete the addition? Do y'all take that in consideration because he's a father that and he's charging her $50,000 less than what the actual appraisal say it would cost to build the house? Would y'all consider that?
No, we have that situation a lot of the time, but the bank
Mhm.
wants to make sure that the home would be built without cutting any corners or anything. So they would go based on the quantity surveyor. And they would still go by the contractor or whoever is building the home. They would still go by that quote, and they would only pay them the amount they're asking for. But the rest would be left as like a safety net if the home isn't built according to the plans. But it can be a big difference, like 50,000.
It can.
No, ma'am.
What you have a percentage, like if a home costs 200,000 and the contractor comes in and say, I can bill it for 175,000.
Usually a 5% variance at most.
An experienced lender can tell, okay, the costs, okay. In relations to term, that is the period of the borrowing, personal loans are commonly no longer than 5 years, while home mortgages loans may extend to 25 to 30. Many people do, however, sell their homes long before mortgage term is up and use the proceed to deposit to improve to value. Okay, so what is the length of time of consumer loans now, Ms. Price?
They could go up to 6 years.
And some people go up to 8 years, up to 9 years. Yeah. Okay. Rachel, take out a new mortgage on their next home. In practice, then the average life of mortgage in the UK is only about 8 years. In Switzerland, by contrast, mortgage can be granted. What? You see that? In Switzerland, you can get a mortgage up to 100 years and can survive the debt of the borrower. Wow. The term of the borrowing is related to the purpose of the borrowing. For personal lending, a loan for an annual holiday ought to be repaid before the borrowers take their next holiday. But a loan for double glazing or a new kitchen could be repaid in 5 years. So if I want a loan for, if I want a loan for, say, for just a vacation, I have to pay that loan off before I come back to the bank again to say, oh, I need another vacation loan. So other than that, you find that getting a loan for a new kitchen or a new bathroom or just new bedroom or putting in a pool or something, I guess you'll get up to 5 to 7 years. If a company borrows funds to buy stocks, it should repay the loan with the sales proceeds of the stocks are received usually within the month. So usually, I guess that's like they're getting a little bridge financing because once you get that stock sold, you need to bring that money to the bank. So yeah, so they just want to increase their inventory. So they have to actually ensure that once they got it sold, they need to actually put pay off the loan to the bank. An overdraft likely to be appropriate form of buying finance here, while a business loan to buy a freehold site of a factory may be repaid on a term of 8 to 10 years. Loans for plant machineries or cars should take into consideration the useful life of the asset purchased because it is likely that another loan will be requested when the time comes to replace that asset. And it would be foolish to have a loan outstanding on an asset that is totally been disposed of, totally depreciated. So a lot of times people get, just like a purchasing a car. When I purchase a car from a car loan, the bank give me that check, I get that car, and I drive that car off the car loan, how much I got with? 80%, 20% less than what it would when I purchase it. Once I drive it off the lot, that's why you find that a lot of people who have money, they don't buy new cars. They go buy a used car because the car really depreciate the minute you drive it off the lot. Miss Adderley, can you wait for me, please? Or Miss Price? Hello? Are y'all hearing me?
Yes, ma'am.
Miss Price, can you either one of you?
She said
Hi.
her mic is having issues. Miss
Who's that?
Price. Miss Price.
Miss Adderley, can you please?
Yes, which part am I reading?
Insurance.
Okay. In the Campari mnemonic, insurance or security is deliberately listed last because the decision whether or not to lend should be based on the other 6 points. With this, a consideration of last resort. Certainly, the ability to secure lending against an asset makes a proposition more attractive than unsecured lending. But the availability of security must not influence the lender to agree to a doubtful proposition. The security provides a secondary source of repayment only in the event that the primary source unexpectedly fails. The questions that a lender ought to ask at this stage are as follows. Is security offered? If not, can some acceptable security be found? Is the security offered adequate? If not, can better or more security be found? What is the nature of the security? See Chapter 11. Who will deposit the security? When will the security be deposited? A banker should generally not extend a loan until the security documentation is complete or the security has been deposited. Finally, additional insurance in the strictest meaning of the word might also be considered under this heading. For companies, ensuring the lives of key directors will be a comfort to the bank. For personal borrowers, insurance to cover sickness, unemployment, or death is also likely to be advised. And when can we go on to consider the criteria that indicate whether the lending proposition will be of benefit to the bank? Keep reading.
Yes, please.
Interest. The first factor that the lender will consider in this regard will be the interest rate that it can charge on the loan, and whether that interest rate is at sufficient margin over the London Interbank offered rate or the bank's own base rate to compensate it for any risk. Typically, risky industries such as construction will be quoted interest rates at a higher margin over base rate than lower risk ones. Similarly, larger firms with good credit ratings are likely to exact finer margins than sole proprietors. Moreover, secured loans are likely to be cheaper than unsecured ones because of the lowered risk of default. Favorable interest rates are one of the reasons for the increasing trend in recent years towards disintermediation. That is, for very large firms to bypass the banks entirely and borrow directly from the markets. See chapter 1 and 2. Personal borrowers will be unlikely to have the luxury of negotiating an interest rate. The rate offered will be the bank's published rate, and this will vary depending on the type of lending proposed. Table 10.2 offers some example interest rates from around the world for 3 types of loans, with the lowest rate available being that quoted.
Thank you. I don't know. Okay, look at 10.2, you see lowest lending rates for retail buying products. And we looked at it, country, home loans, personal loans, credit card, Australia, Germany, Singapore, South Africa, UK, and the United States. Yes, look at it. You will see it again. Prevailing interest rates are influenced by inflation, currency zone, sometimes regulations. Consider the credit card interest rate charges in Singapore. For example, it is higher than prevailing rates in the market and in other economies, and it pitched as a deterrent to over dependence on personal credit. Bank criteria for obtaining credit card in Singapore are also quite restricted. Hold on 1 second for me. No, just go in your room. Go to your daddy. Or you're gonna go in that room to sleep. Go to your daddy. Sorry. Commission and fees. In addition to the interest rate, borrowers may also be faced with commission and other fees such as an arrangement fees to be paid when the loan is drawn down. Occasionally, it is rolled up within the principal amount borrowed and the interest in the pay is paid on it over the term of the loan. When a customer gets a loan, you have administration fees, you have taxes, you have different fees, you have a whole lot of fees, and like I say, fees are rolled up. Miss Price, not sure if your mic is working now, but administration fees, I know before administration fees used to be, if you got a construction loan, it was 1.5. If you got a construction loan, it's 1.5 or 2. I know the administration fees were different for if you got a construction loan or you purchase a house. Is that the same or are they the same? You have the same interest administration fees on them, or it differs if you're purchasing a home or constructing a home? Well, probably still having trouble with them, but, I know before the fees were different, so the bank made more money on if you got if you got a mortgage loan where you purchase a house and a construction loan where you're building a house. So fees differ, terms differ. The difference between commission charge and interest is that interest compensates the bank for risk that is that it takes, while commission compensates the bank for the administrative work which is done by persons involved in gathering and monitoring the loans or overdraft facilities. For instance, a typical arrangement fees for £100,000 home loan would be £500 plus any severe fees or legal costs. We know when you get a loan right off the bat, you have to come up with a certain percentage, which they call closing costs. So in that closing cost, you'd have like, you'd have administration fees, you'd have legal fees, government stamp tax. It's a lot of stuff. And so that's why a lot of times when people getting a mortgage, you'll hear them say, oh, you have to come up with 30,000, 20,000, because that's the closing costs. You have to pay these fees. And as we know, like I say, you have house insurance for the first year. And so these monies have to be there. You have to pay the first year. You have administration fees, legal fees, government stamp tax. So all of these things have to be included. The bank might also charge a booking fee for fixed interest rate and penalties for early repayment. Yes, some banks don't encourage. I don't know, we have that situation here where banks don't encourage you to put money on your principal or try to pay off the loan earlier, because just like a fixed deposit, if you break that fixed deposit before time, the bank actually takes back your interest or give you some of the interest. Well, with persons who try to pay off their loan before time, the bank charge them a penalty for paying off, because right off the bat, the bank knows that if this customer who has a $300,000 or $400,000 loan pays that loan off before time, you know how much interest they lose. And as I always say to persons, when you get a loan, do an amortization and see just how much money going to interest and just how much money going to your principal. And you'd be amazed, and you'd want to be in the shoe that where you would actually put money to your principal every month, even if it's $100 a month for that year, that take off $1,200 of your principal, you know. So that if you can do that every year, or you can do say $2,000 a year, you're taking that off your principal. So interest can be charged on that $2,000. Here again, we're back to 2007, 2008. The UK bank became under fire regarding so-called penalty fees for unauthorized overdraft, and were taken to court by consumer bodies and dismantled. It's now dismantled. Office of the Fair Trading, OFT. The bank won this particular legal battle, arguing that fees were incentive pricing rather than penalties, since they wanted consumers' behavior to change and borrowers to operate within agreed facilities only. So we have people, I guess, you give them one payment, they come to the bank, they say that's all I can pay, so that's what they pay. So that's why they had this unauthorized overdraft, and where the consumers didn't feel that they were being treated right, so they took them to court, but the bank still won. Then you have extras. Finally, the lender should ask itself that are there other products, for example, insurance, travel facilities, unit trust, private banking, that it may offer to the consumer or other members of the family or other businesses within the group to whom products might be sold. Cross-selling is becoming increasingly important as banks find themselves competing for the same customers. To a certain extent, customers can be locked in by purchasing certain services from their bank. In addition, banks are better able to target service towards group of existing customers because they have already built up a considerable data about their spending habits. In some cases, the nature of lending proposition will give rise to the need to a need for the protection that insurance is particularly can bring, life insurance to cover a home mortgage loan, and always adversible because dependents could be left with loan to repay. If the income earner were to die while the loan is outstanding, similarly, a bank will often offer life coverage for companies directors who are virtual to the success of an investment, new investment. And so we know it's banks should enforce that persons take out insurance, especially with a mortgage loan, because you have a mortgage loan, you're a mother and a father, something happened to you, you're incapacitated, you can't work, children are young, one person lived, one person died, and the person who lived is incapacitated, can't work. But if that person, there was insurance on that person, they can still survive because guess what? The insurance will pay off the loan, and most of the time still money left over. And like I said before, um, you're no longer required to have to take out a whole life insurance. Like before you had to take out a whole life with cash values and dividends and all that. Now you can take out a term insurance that is the term of your loan. A loan is 30 years and take out a term insurance for 30 years. The payments are lower also. So here again, all banks should ensure that customers actually have um, life insurance. And I think some banks even do it on, they have a creditor life insurance that they do on persons who get consumer loans. I know back in the days, Commonwealth did it. I'm not sure if they still do, but Miss Adelaide, does Commonwealth still do life insurance for insurance on consumer loans?
Yes, ma'am. The Lawrence I. Mhm.
They still have that.
Yes, ma'am.
The weakness of using frameworks such as Campari is that they can be backward looking. For business borrowing, the lender needs also to consider accounting forecasts, including cash flow, for a reasonable period into the future if it is to be confident that the business will be able to serve the borrowing. That is, make payment of part of principal sum as well as interest. For personal borrowers, this also means judging the stability of a person's employment and their capacity to earn at a level needed to service the loan. Professionals, such as solicitors or doctors, can easily show an ability to earn high salaries, but production workers in the area of high unemployment may not, especially if they intend to depend on fleeting overtime payment to make the repayment. And we know a lot of people have to depend on overtime. Some people work jobs where they have to say, okay, or even taking on extra shift because they know they have this loan, so they gotta pay it off. So yeah, we have people who just use their overtime to compensate their pay for their payment. In addition, Campari and ICE do not consider a very commercial feature of lending that mimic such a parcel derived from persons among repayment securities, expenditure, remuneration, and services, and the four C's: character, capability, capital, and connection. Do the relationship between the borrower and other customers. In the case of the parcels, this is included as expenditure in the four C's as connection. It is possible that the lender may not wish to source the bank relationship with the luxury, the lucrative business account by refusing a loan to say the managing director's son or the daughter based solely on his or her low credit score. And we talk about credit score. Can someone read for me, please? Personal credit score.
Personal credit scoring. We now close the chapter by looking at personal credit scoring, a tool used to inform lending decisions in relation to personal borrowers. Credit scoring is routinely performed as soon as an account is open, informing one of the very first decision made, whether to issue a debit card. Credit reference agencies, CRAs, monitor customers' financial behavior once the account is running and update and augment the customer's scores as a result. These specialist agencies operate worldwide and offer banks services of a quality that they cannot deliver themselves. By granting the CRA information on its customers and agreeing that the information can be shared with others, the bank is able to augment the information that it holds on its own customers and potential customers, with that held on the same customers by other providers. In basic credit scoring for a new borrower, various characteristics of the borrowers and the loan request are each given a rating or score. The numbers are then added up and read off against a range of risk probabilities. This range is then added up and read off. This range is based on the past experience of the lender. See figures 10.2. This experience may mean that a bank or building society takes a policy decision to reject all personal loan application where the calculations suggest that there's more than 10% chance of the loan not being repaid. The potential borrower's scores will be read in relation to this risk percentage and the loan decision informed accordingly. One benefit of credit scoring is that it is consistent and that its success or otherwise can be measured. Scoring is often done by computer with the results shown on the screen to the bank operative immediately. This is very convenient for branch-based transaction and also for direct or internet banking services, since they are unable to meet face-to-face with customers. Moreover, application will also be vetted via a credit bureau to reveal any outstanding county court judgments, CCJs, or current bankruptcies order against the loan applicant. It should be remembered, however, that the scoring process indicates the level of risk associated with the proposition, not whether that particular loan will be a bad debt. Although credit scoring criteria are designed to measure risk statistically, they can be interpreted using the Campari framework, which effectively seeks evidence of stability, length of time at an address, trustworthiness, occupation, other credit and monthly outgoings, ability to manage finances, and residential status, insurance in the form of assets. It should be noted that not only can the pass mark be altered up or down as the lending or marketing policy of the bank changes, but also the credit score can be overridden on a case-by-case basis by a manager who may take other factors into consideration. See Appendix A at the end of this book, for example, of the basic static credit scoring template and a case study to illustrate the principles of credit scoring. Credit scoring is how it, okay.
Mr. Vogt, can you pick up from there, please? Credit score is however cheap to run.
Sure. Credit scoring. Oh, man. Oh, sorry. Credit scoring is, however, cheap to run per transaction. The cost to the bank is minimum when compared to the traditional relationship approach whereby a member of staff would interview every applicant. Speed is also improved. In Chapter 8, we saw how important speed of decision making can be in the context of delivery system, especially in intranet-based transactions. Now, not only do banks have stored for their customers before before those customers ask for a loan, but also banks can use the information to target marketing efforts and to enable customers to apply for loans online. In addition, the whole system is scalable. That is, it can be expanded to different products and branches or across platforms with ease. Given the low unit cost of credit scoring, the consistency and availability provided by automatic systems, and the objectivity of decision-making, it is now surprising that it has become the default for consumer lending in countries with abundant credit data on its citizens. For nations with less developed database, the coastlar subjective decision-making of real people is retained. Another attraction of the credit scoring model is that in time of credit expansion or credit squeeze, or to accommodate different risk appetites, a bank can simply decrease or increase the pass for current products and therefore filter out fewer or more bad prospects as shown in figure 10.3. During the course of,
You can go.
continue?
Yes, please.
Sorry. During the course of customer financial life cycle, CRAs will continue to build their credit score, adding and amending its based on their behavior and on such things as the number of credit facilities open. Banks share this information as well as more negative data on defaults in an attempt to avoid borrowers becoming overstretched. The borrower's repayment record on each facility, any missed repayments and by how many they were missed, CCJs against the borrowers for non-payment of debt and bankruptcy. It is possible to discover your own credit score at any time by applying to a CRA and sometimes paying a small charge. Generally, mistakes in the files can be rectified by a bad payment history cannot be hidden. Now that you have studied this chapter, you may want to consider the case studies and exercise in Appendix A, B, and C. In the penultimate chapter, we look at the type of securities that a bank might request or be offered when considering a risky loan proposition.
Thank you.
Welcome.
Well, like we know, the credit score, the credit bureau, Ms. DeVoe, should be here next year. Totally.
Sorry, I mean, it should be implemented. But I heard Ms. Price mention earlier that their bank is doing it. But I
A lot
know
of people
it's
wanna
not
go to-
regulated by it's not regulated by the central bank.
So
It's
the
nothing
customers
that the customers could make a complaint if a bank declines a mortgage or a loan, the customer, if they have knowledge on it, could make a complaint and say that that's the reason why they were actually declined, because it's not a regulated function as yet.
So they shouldn't be using that to say, you can't get that loan. Okay, any questions, any concerns about chapter 10, which is kind of straightforward, and let's have a lot of things that you can look at, and it helps you to see what you have to actually what banks should use to qualify the Campari, the ICE, the 4Cs, the 3Cs, all of that. So these are things you would have to pay attention to because I can ask multiple choice questions. I can ask true and false questions. So, and it's a good read too, it helps you to see exactly how, for persons who don't work in the bank or who haven't had the experience of working in the bank, to see exactly how loan officers have to actually look at customers before granting a loan to them. Anybody want to add anything? Is it straightforward that you need, or you need any, you want to talk about anything?
No, ma'am, I think it was straightforward.
No, ma'am. Now we have bank securities. Everybody talks about often with bank securities. We know bank securities could be in the form of government salary deduction. Mortgages, usually you would have land. Here again, I also say, and with land, you can have some people who can put up a fixed deposit. Say they want a mortgage for 500,000, they have $1 million in the bank. They can use a fixed deposit as their security. That's something that the bank will hold, that $500,000 until the mortgage loan is paid off. So the person using that to get the loan, they're always also getting interest on that fixed deposit. So they're still winning because they're paying the bank interest and they're actually getting interest on that 500,000 that they got from the bank. They put it on fixed, and then they still have that other 500,000. So when they finish paying the bank, they have that 500,000. They have that million plus in the bank. So a lot of times people don't look at it that they have cash that they could actually put as a security and get, instead of taking the actual cash and actually spending it and buying what they want. So we see here the qualities of a good security. In chapter 10, we looked at the question the lender should be asking persons coming in for a loan, which they did. They used the Campari, which talk about the person character, the purpose, the ability, the amount of repayment, and insurance. As a secondary source of repayment to be called upon in the event that the primary one fails. In effort, security protects the lender in the event that things go wrong. Yeah, it protects the lender when things go wrong, but in the climate that we live in today, how many of you drive by and see houses that are backing up and the bank take and they're for sale and nobody's buying them? How many of you? The bank, a lot of persons losing their homes, the bank making sure they're not living in the homes, but at the same time, the house is being deteriorated. And so when you decide to sell when somebody actually bid on the house, what happens then? You may have the balance on the loan could be 250,000, but the nearest bid you're getting on it is say 150,000 because the house is deteriorated so much because the bank chose to batten it up, put the people out, the yard growing up, everything out of whack. So when somebody come and see it, and they be like, you know how much repairs I have to do to this house? And so I never really understood why, some banks allow people to stay in the house until it's sold, and then some banks put them out and the house is sitting there for 10 years and not sold as yet. In the United States and other part of the world, security is known as collateral. That's what we call it. We will say like when a person get a mortgage, you see them say we have a collateral file which they keep. Some banks keeps it in a vault where so fire or anything they actually kept in the vault. Just like how the cash is, they are called bank securities. So they have to make sure they're always kept secured. So you'll have a collateral file for a customer, their regular file with all their salary, their salary in it, their loan application, their salary job letter, you'd have their ID, all of them in the actual regular file. And then in the collateral file, you'll see them have like, if the person have a life insurance, the mortgage, the conveyance, say it was a conveyance, the conveyance was conveyed from John Doe to John Doe and his wife. So that's a conveyance. And then you'd have the mortgage, which is also in their names, but gone to, say, a Scotiabank or RBC. So those are the stuff that are kept in the collateral files. And like I said, they're stored in a vault because, you know, that's the collateral that you have on that big loan that you have in this, you know, that you gave a customer. So you have to make sure that the collateral is always kept secure. It is interesting to note that the term is derived from the Latin collaterals, meaning side by side, emphasizing that there are two contracts, one for the credit and one for the security. For a particular reason, banks prefer the type of asset ownership of which can be evident by documents, certificates, deeds, such as land, shares, or endowment policy. For this type of asset, no transfer of ownership or sale is possible without the relevant documents, and this gives effective controls over the asset to the person holding the document. So once you convey that to you and then convey to the bank and then the mortgage to the bank, off you, the only way that document is converted back to you, not really conveyed back to you, but once the loan is paid off, the bank would issue a satisfaction. That satisfaction would say, okay, John Doe paid off loan number one, and they have all these different things registered in the registry, this number, and so that loan, that satisfaction have to be done. And a lot of times you find where people pay off their loan and they probably want to go to another bank to get a loan because they're still young and they have things that they want to do, but the bank never did a satisfaction. The bank never did a satisfaction to show that that person completed that loan. So when that person go to another bank trying to get a loan, it's hard because the bank is going to say, oh, you paid them off, so where's the documents and where's the satisfaction? So a lot of times banks don't do satisfaction. So you have to really, when you don't pay off that loan, you go to the bank and you ensure that the satisfaction is done, because it also have to be registered in the Registrar General Office. All documentations, all those documents, a mortgage, a conveyance, they have to be registered. And then sometimes too with collateral, you'll have like, sometimes you have persons who marry, and so they not putting that person name on it. So the person have to sign out their dower. And some persons sign out their dowers to say, okay, yes, he getting a loan, but I don't have a dower in it. So they sign out their dower. So that's something also should be kept in the collateral file. In contrast, the ownership of chattel, such as a car, and we know with car loans, is always a chattel done over the car, or machineries, furnitures, they call them chattel. So they also are registered. They have to be, the lawyer have to draw them up and they have to be registered. So that's like a collateral. It's a chattel over the car, over the machineries, over furnitures. However, valuable such may be because documentary proof of ownership is not standardized. They cannot be changed or controlled as effectively as security. For business owners, for business borrowers, assets that change in the course of business can be captured under a floating charge, in which we look later in the chapter. This type of charge is available in a number of legal jurisdictions. By contrast, the finance company will use a car or machinery as part to support lending, such as finance companies retain ownership but not physically possessions of the asset until it is paid for. There can be tax and cash flow advantage of this, but it is not really security in a banking sense. Another common security is guarantee, and we talked about that because I can guarantee something which is given by a person jointly and severely, or by a company which comprises a promise to pay the bank should the borrower default. So company could say, I guarantee the loan for Mr. Paul. So if Mr. Paul can't pay, the company gotta pay. So this document is put in the customer's collateral file also because it's a guarantee. It's something, it's a safety net for the bank in case that person default, but Mr. Paul decided that he was gonna use this company and guarantee the loan for Mr. Joe Doe. So the bank also, that document, the guarantee document, which is signed by the customer, stamped by the bank, everything, all of that has to be kept in the collateral file also. Then we have mass tests. Miss DeVoe, can you catch some the first part of this for me? No, where is Miss Tamika Sinville? Can you read for me, please?
Good night.
Good night.
One method of measuring the effectiveness of an asset of a security is known as the mass test. In relation to assets held as security, the
Numeric. Mnemonic stands for
MONIC stands for marketable. That is how weekly it could be sold. Sorry,
Miss Pierce, Miss Price, you still having problems with your mic? Miss Adderley, I know you tired of reading, but my throat is so dry.
I can read,
Okay, okay, Miss DeVoe.
Where exactly, where are we, sorry?
She was still at the mass. I think it was the second one.
In chapter 10?
No, we're in chapter 11.
Oh, the mass test, sorry. One method of judging the effectiveness of an asset as security is known as the mass test. In relation to assets held as security, the MENOMIC stands for marketability. That is how readily it can be sold. Sustainability of value, that is how easy it is to value accurately. Simplicity of title, that is how easily ownership can be proved. And transferability of title, that is how easily the bank can gain ownership so that it can sell the asset. Land, especially domestic property, is said to be good security and meet the requirements of the mass test in the following ways. There is normally a good market for property, especially in particular areas. Industrial premises or shops may be more difficult to sell because this can depend on the planning permission needed regarding the use of land and the state of the economy. In many economies, property prices are easily ascertained by reference to professional surveyors and valuers, or simply by looking at similar properties in the vicinity. The so-called driven by valuation. In the UK, land registration guaranteed by the government since 1925 provides for a very simple way in which to find out who owns a particular plot of land and who may have a mortgage over it. In other jurisdictions, however, the legal ownership of land and the rights enjoyed by the owners will vary. See Table 11.1. Finally, transfer of title over land to a bank is effective through the mortgage deed or change form. This provides for the transfer of ownership to the bank in the event of a default on the loan it secures. The bank must return to the original owner any funds not needed to repay the loan, that is the surplus, if there are any. Again, rights to occupancy and protection for families in distress will vary between jurisdictions.
Okay, like we know, I just want to explain something. Like we know, a house is being sold, like it said, surplus. A house is being sold for 250,000, but the mortgage balance is say 120,000. So the bank, that customer is entitled to whatever the surplus after all the fees have been paid and everything have been paid, whatever the surplus is, the customer should be given to the customer. But then we have on occasions where the house was sold for less than what the actual loan amount is. I know some banks or they ask the customer to sign some kind of form that probably still say they're liable if the house is not sold for the amount to cover the total loan. I don't know. I know back in the days that's what happened. I don't know if it still does. But some customers don't walk away with anything because house was so in such terrible shape that the bank could not get even what they were asking for it. And like I said, reiterate again, with banks putting customers out the house, and because they do that, the house deteriorates. And so when they sell the house, whatever the value they put on it, the market value and the value that the bank want to sell it for, they can't get it because the house is in a terrible condition. So like I say, some people walk away with something and some people walk away with nothing. You don't have to go over the chart, Miss DeVoe. You can go from other physical asset for me.
Other physical assets, such as antique furniture, that is chattels, however valuable, makes a rather poor security when subject to the mass test. There is normally a good market for it. Valuation is often based on opinions of experts, and there can be wide varieties based on the condition of the furniture and its provenance, among other things. Titles is evidenced by sales invoices, but these are not official documents and can easily be forged, especially in the case of stolen furniture. Transfer to the bank will be impossible if the title cannot be confirmed. In addition, the bank cannot control an asset without looking it away, and banks do not really want to do this without cattle on a regular basis. Securities that fail the mass test but remains popular include the unsupported guaranteed and the floating charge, as we will see later in this chapter. Leasing and collaterals. Lenders often use personal contract plans, PCP, and commercial leasing deals to finance the purchase of specific assets such as vehicles, machinery, and computer equipment. Under such a deal, it is purchased assets itself, the car or the computer, That is, in effect, the security, ality, not in a strict sense. In that its legal remains the property of the lender until the loan or payment plan has been paid in full. The legal
Thanks,
environment,
No,
sorry.
thank you. So we see why we should have collateral. Now we see the legal environment part of it. There are the last two elements of the MAS test relates to the legal environment within which the bank and the customer and the secured asset resides. This is a complex area, but the well-informed banker will take the environment into consideration when deciding on credit policy, establishing procedures for taking securities and dealing with the disputes and recoveries. At the macro level, the lender will consider the type of legal system that is the basis of the law, the maturity of the profession within the legal system in question, the transparency and efficiency of the legal processes and courts, and the level of corruptions within the legal environment. Each country has its own legal system, including its own set of laws and procedures to deal with that contract. There are, however, enough similarities between systems to be able to categorize them as shown in Table 11.2. For the banks working with typical loan ordinary customers and asset situated wholly within their national border, there is a little option but to use the prevailing domestic legal system as a basis for contract and dispute resolution. For larger and cross-border deals, however, banks may choose to stipulate the basis in the laws in which the loan contract is to be interpreted. For many large or cross-border loans, banks often choose the law of England and Wales because it can offer swifter resolutions, more transparent treatment of claims, and relatively credit-friendly rules than do others jurisdiction. As we know, some banks here, banks, I never even knew banks give loan to other banks. So, and like they say, if I'm giving a loan to Bahamas is giving a loan to Switzerland, say Credit Suisse is giving a loan to another bank, they actually use, just like AML, they actually use the laws that relates in that jurisdiction. Okay, y'all can look at Table 11.2. The advantages and disadvantages of taking security. We know if you don't take a security, it's a moral hazard. You don't take a security, what happens? Somebody dies, house, the bank loses because you didn't take the correct securities. Like I say, you didn't take life insurance. That was one of them that, hey, person died, now what are you gonna do? The main advantage of a bank, to a bank taking securities is that it reduces the risk of moral hazard. That is the risk that the borrower will behave in a way that alerts the risk profile of the loan after the money has been issued. Once I get the money and y'all ain't take the right security, or would y'all want me to? I don't spend that. If you choose to give me the money and say, I'm gonna come back and ensure that I take out the car insurance and make sure that the bank has lost pay, and you didn't do that, and something happened to the car, what happens? The bank at fault. We have a lot of persons today, they go and sell the car, they get the loan from the bank and they sell the car. And when they don't make the payment and the bank go looking for the car, they don't sell the car. And the person who they sell it to, then sell it to somebody else. So, the bank has to ensure that these things, so when anything happen, at least that insurance says, the bank is the sole owner, but a lot of times people don't do it, and the bank the loan officers don't ensure that these things are done. So the bank is not noted on the insurance as lost payee. They don't have the bank there, so it's just the customer name, so they don't have anybody located, noted on the insurance as lost payee, which should be the bank. Security imposes pressure aiming to dissuade the borrowers from doing so in an advertisement for home mortgages. For example, borrowers are warned clearly, your home may be repossessed if you do not make your repayment on your mortgage. A strong incentive to keep up monthly repayments and maintain the loan risk portfolio profile. A further advantage for some loans is that sales of the asset purchase will provide secondary repayment vehicle in the event that the borrower failed on the loan. Holding the asset as security ensures that the sale proceeds goes directly to the bank. Sometimes you have persons who have life insurance, which is tied to the bank. And here again, it has lost payee as the bank on the actual insurance. So a lot of times you'll have customers, nowadays now customers will take out term insurance, but before you had customers who just put their insurance with, they have the cash values, dividends, or whole life insurance. So what would happen? Anytime that person want to get dividends or get cash values of their insurance, which is in their account, which they have accumulated, they cannot just get it. They have to actually take that check to the bank, and the bank signs off on it for that person to actually be able to cash that check, because you have the loan with the bank. The bank is lost payee. So at the end of the day, if your loan is not up to date, the bank taking the check, you're not going to get that. So a lot of times people have cash values and dividends, and they just want to get it from the insurance company. But because the bank is noted on their life insurance is lost payee, the bank has to also co-sign on that check before that customer can cash that check. The lenders have to ensure that the mortgage is up to date before the check is paid out or cash or given back to that customer for them to cash, as long as their account is up to date. If it's not up to date, the bank is not going to give it to them. A future advantage for some loans in the sales is that sales of the asset purchase will provide secondary repayment vehicle even though the borrower default. Holding the asset security ensure that the sale proceeds go directly to the bank. Finally, securities also act as insurance against the impact on the lenders of external events such as debt of the borrower or borrower redundancy. Taking security also has a disadvantages, however, because the legal process needed to perfect the securities. And we know people can take securities, but hey, we have incidents where customers, I guess lawyers don't do their due diligence, that when they actually do the title search and they do the opinion of title, which the bank gets, say property so and so is correct, and when you the other owner of the other piece of property comes along and say, you're built on my property. So even though banks take security, there's that iffy. I don't know if y'all remember Charles Sanders Highway, when the church, when our home said it was their property and the church said it was their property, and they had to break down, the church had to get break down. So it's like you have to ensure, because we have a lot of persons today can't move in their homes. It's just there because they can't come to a legal arrangement with the person who they gone and build on the wrong property. So yes, so even though the lawyers, you have the lawyers, sometimes they don't do their due diligence, so their opinion of title that they give is a whole long sheet that they give, reflects lot A, when it should have been Lot B, and the person billing on Lot A, and it's not their property. So yes, there are disadvantages when you have security. Alrighty, and then we have taking security also have its disadvantage legal process. That is, make the arrangement watertight can be costly and may delay the loan. This can make a bank loan uncompetitive. Another bank may lend the money without security at all. As a general rule, borrowers below certain amount will be agreed on an unsecured basis since the cost competitive and time factors are too great and reduce the bank's profit on the deal. Another disadvantage is the reputational risk that can be involved should a bank image be tarnished when, for example, a company fails and the bank must seize and sell the factory premises to ensure that the loan is repaid. If this course of action leads to job losses, the bank is often to blame. So here we see if, like they say, if a company, a business is sold and a lot of people lost their job, everybody blaming the bank. They even look and say the man didn't pay the loan, he get the money, but he didn't pay the loan, so the bank have to claim. Finally, there is an argument that taking securities can actually increase the risk of moral hazard. If a company director charges all company assets to the bank and supports the company with personal assets, the family home, a shared portfolio, or a life policy, that the director may think that there is nothing left to lose if the company fails and may consequently take higher risks than might otherwise be the case. Okay, we'll stop here and we'll go on Thursday to finish this chapter and try to finish chapter, well, we will finish chapter 12, which will be the last chapter. So if you can please read up on this where we left off. So when you come on Thursday, we don't have to actually be going through it like this. So we can just talk about things that you didn't understand. Much appreciated, because we have to read. It's just 2 more chapters, this chapter and chapter 12. So much appreciated if you would go through where we stop and pick up from there, looking at the different securities. We talked about the land, and we talked about the guarantee, talk about the floating charge, the fixed charge. So if we can just go through and look at the typical consideration, which taking UK land is the DIVAN. So these are the things you have to, go when you go home to actually read and look up for me, please. So we can, when you come on Thursday, we can complete both where we left off and finish chapter 12. Okay? Any questions, any concern?
No, ma'am.
No, ma'am.
Okay. Well, like I say, your assignment is due, what I put, the 17th? Can't remember. But assignment is due next week, I think. And like I say, once we finish, I'll try to have your other assignment. It'll be the last assignment, probably chapter 9 and chapter 10 and chapter 11. Okay, I'll be your last assignment. Righty? And like I said, we'll go from there and see with the review sheet what will happen from there. Okay, but we'll talk about it more on the can you go where we left off, if you continue and go. So when you come on Thursday, we just have to peruse it and actually discuss points that y'all don't understand. Okay.
Yes, ma'am.
Good night.
Good night.
Good night.
All right.
Good night.